Welcome to Wealth Wisdom. If you have ambitions to achieve financial success, please leave yes in the comment, and we are here to help you obtain insight and build wealth. The book we are going to share today is Getting Good with Money by Jessi Fearon. The different types of money struggles. Personal finance is just that, personal. Everyone's experiences are different. That said, money struggles can typically be separated into 4 categories that correspond with different personality types. The first category is the floater. These individuals are stuck living in the paycheck-to-paycheck cycle, with seemingly no end in sight. Floaters may feel like they aren't making any headway toward their financial goals, so they often give up altogether. Next, there's the daredevil. This archetype can easily be identified by their lack of a savings account. They may not be stuck in the paycheck cycle, but they can't make big purchases without sinking into debt. Third, we have the spender, people who just can't seem to control their excessive spending habits. Spenders might justify their purchases as amazing deals, but they often fail to stay within their budget. And our last category is the avoider. These individuals are so wrapped up in major money issues, like paying off student loans or saving for retirement, that they're completely burned out. Weighed down by all of their responsibilities and worries, it's easy for this group to lose sight of their future. Most of us will fall into at least one of these categories at some point during our financial journeys. You may have found yourself identifying with one, several, or even all 4 of these personality types already. It doesn't matter where you are in your personal struggle with money, identifying your unique type is the first step to making real, positive changes. The truth is, learning to manage money is about 20% math and 80% changes in behavior. In other words, you're going to have to discover what actions have led you to where you are now and figure out how to change them in order to improve your situation. For instance, floaters can benefit from learning how to create and stick to a budget. Daredevils will be on much more solid footing if they build up a savings account. Spenders can see improvements from discovering and then steering clear of their triggers when it comes to overspending. And avoiders can fix their issues by reevaluating their future goals and creating a plan to put them into action. Before we continue, if you are interested in this topic, please consider subscribe and give us a thumb up. Let's continue. Creating a budget. If the thought of sitting down to create a budget makes you want to sprint in the other direction, don't worry, you're not alone. Many people avoid budgeting because they think it'll be too much work, but the process doesn't have to be complicated. To make things simple, Jessi uses what she calls her quick start budget. This method is great for beginners because it's straightforward, easy to implement, and doesn't require a lot of setup. In fact, all you need is your checking account balance, a calendar, and a calculator. First, take your current balance and subtract any bills that are due between now and your next paycheck. Make sure to include pending charges that haven't yet hit your account. The amount of money you have left is what you can use to budget for essentials like groceries and gas. You could have another section for entertainment and another for savings. Assign a certain amount to each section until the balance is $0. This is what's called a zero-balanced budget. Some financial gurus will suggest that you focus on putting something into your savings account every single month, but Jessi tends to disagree. While it's important to contribute to a savings account when you can, bills should always take priority in her book. Each time you get paid, add your paycheck amount to the balance of your previous budget. Repeat the same steps as before, check your calendar, make a list of your bills, and then balance the rest of your budget. And that's it. See, that wasn't so bad. The key benefit of the Quick Start budget method is that it builds smart money habits. Not only will it help you keep your money organized, it will also get you into the habit of paying attention to what's coming in and going out. And the more you do it, the easier it will get. Emergency funds. Take a moment to imagine the unimaginable. What might happen if you suddenly found yourself in a life-altering emergency? What if you got into an accident or lost your job? Would you be able to survive for months without any sort of income? This is what an emergency fund is for, a hefty savings account meant to protect you and your family if the worst were to happen. Building up this kind of fund definitely takes more time and effort than a regular savings account, but it can make all the difference if your life gets turned upside down. The goal is to have enough money in your account to keep you afloat for 6 months without any additional income. To calculate this number, add up all of the essential expenses you have each month, and multiply the sum by 6. That's the total amount you'll need to save. This number is bound to be pretty large, but don't let it intimidate you, it's only the end goal. Aim for a smaller starting point, and work your way towards saving more each month. Even if it's really tempting, try your best not to dip into this fund whenever you need to pay unexpected expenses. While working your way toward financial freedom, building up an emergency fund might seem counterintuitive at first. How are you supposed to put so much money aside if you're trying to pay off all of your debt? The truth is, while creating an emergency fund might mean it takes a little longer to become debt-free, it's the key to staying debt-free. Emergencies will happen, and when they do, it won't matter if you've paid off every cent that you owe. If you don't have something saved up to keep you going during the worst-case scenario, you could end up right back where you started. Debt repayment, snowball versus avalanche. Racking up debt is a lot like gaining weight. It's easy to do, and can either happen suddenly or creep up on you over time. And, like shedding pounds, it's a struggle to get rid of. There's no magic pill for weight loss, and there's no quick, easy way to get out of debt. It's only going to happen if you roll up your sleeves and put in the work. It might feel scary, but don't panic just yet. From her personal experience, Jessi believes that paying off debt is actually easier than building up your savings. This idea might sound a little strange, but tackling even a small part of your debt can motivate you to keep going toward the finish line. There are 2 main strategies for repaying debt, the snowball method and the avalanche method. With the snowball method, you pay off your debts from smallest to largest. Just like rolling a snowball up a hill, you start small and build your way up to paying off bigger balances over time. The avalanche method takes the opposite approach, starting big and ending small. With this strategy, you pay off your accounts with the highest interest rates first, working your way down to the lowest. For either method, you should follow the same basic strategy. First, always prioritize debt repayment when going over your budget. If you have a steady income, put aside a specific amount each month that will go toward the minimum payments on your debt. If your income is a little irregular, use any leftover funds when you can. The next step is to find ways to reduce your expenses and increase your income. We'll discuss some specific ways to do this in a bit, but the basic idea is to boost the amount you'll be able to pay down each month. No matter how you choose to repay it, Jessi has one golden rule for getting and staying out of debt: stop using it. This means no borrowing money, no new loans, and, you guessed it, no credit cards. This likely goes against everything you've ever learned about money, but it's the only way to truly live debt-free. Paying off your mortgage. Now let's cover a few points about paying off a mortgage. One of the most common assumptions about mortgages is that interest won't end up costing much if you have a low rate. What many people don't understand is the concept of total interest percentage, or TIP for short. Let's say, for example, that your 30-year mortgage is $300,000 with an interest rate of 4%. If you pay off that loan over the course of the entire 30 years, it will end up costing you $515,608 in total. Why? Because with the cumulative impact of TIP, you're actually paying 72% interest on the loan, which would end up being over $215,000. Understandably, discovering this fact encourages a lot of people to start paying off their balances faster. Before you start the process of mortgage repayment, you'll need to know a couple of things, specifically, which type of mortgage you have and if there are any penalties for paying it off early. When in doubt, it's always a good idea to call your bank first to avoid being hit by any surprises. As you pay off your mortgage, your best friend will be something called an amortization table. This is basically a way to see the impact of each one of your payments, plus the calculated interest rate, on the principal of your mortgage. There are many free amortization calculators online that you can use to crunch the numbers. For example, you could change the speed of payment from 30 years to 10 and see how this affects your payment amount. Keep in mind that the less time you put in, the higher your monthly payment will be. But the benefit of knowing this number is that it gives you a goal to reach for. Even if it isn't totally doable for you at the moment, you can use this context to inform all of your financial decisions and monthly budgets. Making space in your budget. Whether you're trying to tackle debt, build an emergency fund, or pay off your mortgage, making space in your budget is one of the fastest ways to achieve your goals. Stretching your budget might be difficult at first, but even small tweaks can have a big impact. A good place to start is by determining what's eating up most of your budget each month. Ironically, a likely culprit is food. Cooking is a great way to save money. Takeout and frozen dinners are convenient, but they usually cost much more than the meals you'd make at home. It's also a good idea to always shop with a list so you only get what you really need. Another way to save some extra money is by taking inventory of the luxuries you're paying for and deciding if they're really worth the money. For instance, you could cut down on the number of streaming services you're subscribed to or cancel the gym membership you don't use enough. Finding ways to keep costs down is essential. But to make space in your budget, you also need to increase the money coming in. That's easier said than done, but here are a few tips. Let's start with the obvious. You could raise your income by switching to a higher-paying job, asking for a raise, or even taking on a second job. If you have extra time, you could also consider starting a side hustle. If none of these routes are feasible, there are other options. To drum up some extra cash, you could try selling things you no longer need on popular marketplace websites. Another lesser-known option is to negotiate your utility bills down to a lower price. By spending a couple of hours on the phone with your providers and asking about lower rates, you could potentially save yourself quite a bit of money each month. Of course, this isn't an exhaustive list of ways to stretch a budget, but it's a good place to start. This is your opportunity to get creative and see what works best for you. It's easy to look at the big picture process of saving money, but remember to sweat the small stuff. Taking baby steps and focusing on the details will pay off in the long run. ChatGPT. Certainly. Here's a rephrased version of the text you provided. The various types of financial challenges. Personal finance is inherently unique to each individual. Everyone's financial experiences differ. Nevertheless, money-related difficulties can typically be categorized into 4 groups, each corresponding to different personality types. The first category pertains to floaters. These individuals find themselves trapped in a never-ending cycle of living paycheck to paycheck, often feeling like they're making no progress towards their financial goals, which can lead to a sense of hopelessness. Next, we have daredevils, identifiable by their lack of a savings cushion. While they might not be stuck in the paycheck-to-paycheck cycle, they struggle to make significant purchases without accruing debt. The third category encompasses spenders, individuals who grapple with controlling their impulsive spending habits. They often rationalize their purchases as great deals but frequently exceed their budget. Lastly, we encounter avoiders, individuals preoccupied with significant financial concerns such as student loan debt or retirement savings. This constant burden can lead them to lose sight of their future goals. Most people will find themselves fitting into one or more of these categories at different points in their financial journey. Identifying one's unique financial personality type is the initial step towards making tangible, positive changes. It's essential to recognize that mastering money management is about more than just mathematical calculations. It involves a significant shift in behavior. In other words, understanding the actions that have led to the current financial situation and implementing changes is crucial for improvement. For instance, floaters can benefit from learning how to create and stick to a budget. Daredevils can find stability by establishing a savings account. Spenders can make progress by identifying and avoiding triggers that lead to overspending. Lastly, avoiders can overcome their challenges by reassessing their future goals and formulating a concrete plan to achieve them. Creating a budget. If the idea of creating a budget seems daunting, you're not alone. Many people avoid budgeting, fearing it will be overly complex. However, the budgeting process can be simplified. To keep things straightforward, Jessi recommends her Quick Start Budget for beginners. This method is easy to implement and requires only your checking account balance, a calendar, and a calculator. Start by subtracting any upcoming bills, including pending charges, from your current balance. The remaining amount is what you have available for essentials like groceries and fuel. You can allocate funds to other categories, such as entertainment and savings, until your balance reaches zero. This is known as a zero-balanced budget. Some financial experts advise consistently saving each month, but Jessi suggests prioritizing bill payments. With each paycheck, add the amount to your previous budget balance and follow the same steps, accounting for bills and budgeting for other expenses. The key benefit of the Quick Start Budget method is that it cultivates good financial habits. It not only keeps your finances organized, but also encourages a habit of monitoring income and expenses, making budgeting easier with practice. Emergency funds. Imagine facing an unforeseen life-altering emergency. What if you had an accident or lost your job? Would you be financially prepared to sustain yourself and your family without income? This is where an emergency fund comes into play, a substantial savings account designed to provide security in the event of the worst-case scenarios. Building such a fund demands time and effort, but it can be a game-changer if life takes an unexpected turn. The goal is to have enough savings to cover 6 months' worth of essential expenses without additional income. To calculate this amount, tally up your monthly essential expenses and multiply the total by 6. While the target may seem daunting, it's important to start with a smaller goal and gradually increase your savings each month. Avoid tapping into this fund for non-emergencies, as it's the key to staying debt-free. While it may seem counterintuitive to build an emergency fund while working on paying off debt, it is essential. Emergencies can strike at any time, and without savings, you might end up back in debt. Debt repayment, snowball versus avalanche. Accumulating debt can be likened to gaining weight. It happens gradually and is challenging to reverse. Similarly, getting out of debt requires effort and commitment, but it's achievable. Jessi believes that paying off debt is actually easier than saving money, drawing from her personal experience. Even addressing a small portion of your debt can be motivating and propel you toward your financial goals. Two primary strategies for debt repayment are the snowball method and the avalanche method. With the snowball method, you start by paying off your smallest debts and gradually move to larger ones. It's like rolling a snowball uphill, beginning with manageable debts and progressing to larger balances over time. The avalanche method takes the opposite approach, beginning with high-interest debts and working down to lower ones. In either method, prioritize debt repayment in your budget, allocating a specific amount each month towards minimum payments. Look for ways to reduce expenses and increase income to boost your monthly debt repayment. Jessi emphasizes one golden rule for achieving and maintaining a debt-free status: stop accumulating new debt. This includes refraining from borrowing money, taking out new loans, and avoiding credit card usage, a strategy that may challenge conventional wisdom about money management but is vital for true debt freedom. Paying off your mortgage. Now, let's explore some key aspects of paying off a mortgage. Many assume that a low interest rate means that interest costs won't be significant. However, the concept of the total interest percentage, TIP, often goes misunderstood. For example, on a 30-year mortgage of $300,000 with a 4% interest rate, if paid over the entire term, it can cost a total of $515,608. This is due to TIP, which translates to paying 72% interest on the loan, amounting to over $215,000. Before embarking on mortgage repayment, understand your mortgage type and check for any penalties for early payment. It's advisable to contact your bank to avoid surprises. During the mortgage payoff journey, an amortization table becomes your ally. It shows how each payment impacts the principal and interest of your mortgage. Numerous free online amortization calculators can help you analyze the effects of different payment timelines. While shorter payment terms result in higher monthly payments, knowing these numbers provides a clear goal. Even if you can't achieve it immediately, this information informs your financial decisions and monthly budgets. Creating room in your budget. Whether your goal is debt reduction, building an emergency fund, or paying off your mortgage, making room in your budget is essential for achieving financial objectives. Initially, it may be challenging, but even minor adjustments can yield significant results. Start by identifying the primary expenses consuming your budget, with food often being a major culprit. Cooking at home can save money compared to takeout or frozen dinners. Shopping with a list helps you purchase only what you genuinely need. Another strategy is evaluating the value of luxuries you're paying for and considering if they are worth the cost. Reducing the number of streaming services or canceling underutilized gym memberships can lead to savings. To make room in your budget, you must also increase your income. This can be achieved by switching to a higher-paying job, negotiating for a raise, taking on a second job, or exploring side hustle opportunities. Selling unused items on online marketplaces and negotiating lower utility bills are other options to generate additional income. While these are not exhaustive strategies, they serve as a starting point. That's the end of today's sharing. If you like our content, please give us a thumb up and share it with your friends. See you next time.